Welcome to the Show Me the Money podcast, Unlocking Property Finance. Join us on an exciting journey into the world of property finance, where we uncover secrets, strategies, and opportunities that can turn your property dreams into a lucrative reality. Welcome to Show Me the Money, Unlocking Property Finance.
Hello.
Welcome to the Show Me the Money podcast, Unlocking Property Finance. Join us on an exciting journey into the world of property finance, where we uncover secrets, strategies, and opportunities that can turn your property dreams into a lucrative reality. Welcome to Show Me the Money, Unlocking Property Finance.
Hello.
Welcome back to another episode of Show Me the Money, Unlocking Property Finance with myself, Sharma, and
Marc Champ here again.
Here we are.
Joined today by my good friend Joseph Robertson. We worked together at Lloyds Bank, but now is at Handelsbanken. So welcome, Joe.
Thank you.
Interesting. So Handelsbanken, it's not a bank that many people have come across or have necessarily done their work with. So it's a great opportunity to learn a little bit about them, how they work. But tell us a little bit about yourself, Joseph, in terms of your background and how you've got to where you are today.
So thanks very much, and thank you for this opportunity. I've been in banking for about 18 or 19 years now. I lose count. I started as a barrister's clerk years ago and then moved into banking in 2004. Over my career, I've moved around lots of different banks. Handelsbanken is actually my sixth bank that I've worked in, but notably, I've been at Lloyds Bank for 12 years, latterly as a relationship director in the SME market before moving into Handelsbanken. I've been here about 4 years. I joined as a corporate banking manager looking after a portfolio of corporate clients. And about 2 months ago, I moved into the deputy branch manager role here in the West End, where I run a team and also support the branch manager to run the branch.
Fantastic. And tell us a little bit about Handelsbanken then, their background, origins, and what they predominantly focus on, sort of clients you work with. I'm sure there's plenty more questions that will come out as well, but let's learn a little bit about the bank.
Very happy to. So Handelsbanken, you're probably right by saying you don't necessarily know a great deal about Handelsbanken. You probably would have seen our name splash up on the CMA posters in every bank branch. Service is absolutely key to us. It is the product, basically, if the bank can define it. Our background is Swedish, and so Handelsbanken originates in Sweden and then opened up in the 1980s here in the UK. We've got about 160 or so branches, maybe a little bit over that now, across the UK. But chances are you probably don't really know much about them. And it's typically because Handelsbanken is a bit of a private bank. Our customer base tends to be very local. We have a traditional banking operation with a decentralized model, which means that all of our branches operate independent of one another. So although we're part of a much bigger bank and we've got our own head office, we've got our own shared resources, each bank branch will have its own client base. It decides how it wants to approach its own market, how it wants to be part of its local community. And it means we can make better quality, quicker decisions when it comes to credit. 99% of the credit decisions we make happen in branch. And that's something that you don't typically see in banks nowadays. So our view is the closer we are to the customer, the closer we are to making those decisions, the better we can be and the better our bank is. And this actually shows through to the overall credit perception of the bank. If you look at our external ratings, Handelsbanken is the strongest commercial bank in Europe. And that's because we're very, very conservative about how we lend, quite traditional about our approach to lending. And it also means that we manage things in branch. So if things go wrong, we have to manage it here. We don't send it off to another team to deal with our problems. We work with customers to get them through that. And as a result, our credit losses tend to be nominal.
It's interesting you say about service, because in the episode we recorded last time out, we talked about service and also about funding. And it was interesting that you mentioned service, because when customers come to me as a broker, never once have I had which lender's going to give me the best service. That question never comes up. It's strange, because it should do, because at the end of the day, you don't go and buy a clapped out old car. You go and buy a nice car that's going to get you from A to B in a bit of comfort and gives you almost the nice, easy drive to where you want to get to, and you don't mind paying a little bit extra for that. And I know, dealing with Handelsbanken, it does make a difference, the non-centralized model they have, because you can go to another bank and say, right, we want to do you're talking to a Lloyd's relationship manager based in London, for instance, and you want to do a deal for a customer based in Newcastle, but there's one credit policy, one set of rules, and that's what has to be adhered to. So having that non-centralized model really does work, and I think that is a big USP of yours.
It's essential.
How about the things like the operation? I mean, obviously, like the credit control, your underwriting then takes place in branch. Presumably, there's a lot of back office processes that then do get done sort of off-site somewhere in a centralized fashion, or is much of the operation,
most of it,
actually done in the branch as well?
Most of it's in the branch.
Okay.
And that's the thing that surprises. If I looked at most of the things that we do as a bank, I would say more than 9 out of 10. So maybe 95 out of 100 things we need to do as a bank, we do in the branch. So whether that's managing payments, daily excesses, supporting customers with some difficulties they've got in terms of moving money around, our wealth management, our corporate banking, our private banking, it's all in branch. And that's the bit that I found quite interesting when I first joined the bank. Now, bear in mind, this is my 6th bank, and I'm used to having central teams doing things for me. But all of a sudden, I joined Handelsbanken, and all of a sudden, I've got to do it myself. So I'd say the first 6 months joining Handelsbanken was probably the most challenging, because you've got a lot that you need to get yourself clued up on. Having said that, we're much more empowered to be able to make the decisions and to do the things that matter to customers. And that's the big difference. Having worked in many banks, and I've got a lot of respect for other banks that I've worked in, the number one challenge that relationship directors and managers will say to leadership is we don't feel empowered. And that also has an impact on your customer relationship. So it's not just about how you choose your customers, how you underwrite your deals. It's also about how do you make a difference day to day. Our customers will phone us up and tell us, I've got to make this urgent payment, but I don't have access to my system. I can't do this, I can't do that. And we have the ability to be able to do that for them pretty much on the spot. So we don't like to do it all the time. Obviously, we'd love our customers to be able to do what they need to do with the bank themselves. But what it demonstrates is where the private banking difference matters. All of our colleagues in our branches know the customers in that branch. We're not just one central office team that doesn't actually have that face-to-face relationship. If we get a call from customer A, chances are everybody in the branch is going to know who they are, and everyone pulls together to support them. So decentralization is absolutely key to Handelsbanken's model. It's core to our culture, and it's absolutely essential that we keep it in place as we have.
And 2 things you said there, Joseph, that really struck a chord with me. Number one, the centralized teams that the other banks use. And I remember when I was at Lloyd's, and you had to ring up the Penderford Security Centre, and you had to try and locate documentation and do all these things. And invariably, there's some really good people there, but invariably you get passed from pillar to post, and documents would go missing. They would have to be sent down from Birmingham, and it was an absolute nightmare. And in the end, you've just written the head of the Penderford Centre and say, look, I need you to do me a favour. Can you sort this out for me? And that's not the way it should be. It should be that you're in charge of your own destiny, and also the documentation that your customer needs. The other thing you mentioned that was interesting was you have the wealth managers here. And right, we were talking in the last episode about your wealth strategy and how it's important that you look at your risk and your appetite for growth in a holistic view. And having your bank manager and your wealth division in the same place and all talking to each other and doing this, it's a joined up approach. It makes the world of difference for your overall strategy, in my opinion.
Absolutely. Interesting. I've got some more questions on the model as well then. So first of all, tell us about your typical client or customer. For people who are taking out sort of lending or mortgage products, they need to be an existing customer of Handelsbanken, or could somebody else come straight to you for a for a mortgage, for example? And actually, another question which we should clarify is, what type of lending products do you offer? Is it just term loans, mortgages, or do you do sort of development and bridging finance as well?
So in terms of a typical customer, there probably isn't one. But if I could give you, if I look at my own portfolio, it ranges anything from a sole trader, property investor, all the way up to a global corporate type business with offices all over the world and pretty much everything in between. Typically, we think if there is a sweet spot, it will probably be the mid-range property investor where they've got rental portfolios, but can be across commercial and residential. In various different structures, we've got husband and wives, we've got sole traders, we've got corporates, we've got partnerships. So it really is a big range there. If customers wanted to bank with us, they could just pick up the phone to the local branch. If you look on our website, type in the postcode finder, type in your postcode, and it will tell you who your local branch is. You'll probably find they're closer to than you think. Generally hidden there somewhere, but they're close. We like to be close to our customers. Lending and deposits are a great way to start a relationship with the bank. We're very happy to talk to customers about any of their needs. In terms of products, it's pretty broad. I wouldn't want to go specifically into products, but I would say is that our product range is on our website if you want to see the kind of stuff we're doing. Having said that, because I guess there's a bit of a leading point here, development finance for property is not something that Handelsbanken typically do. Having said that point, though, if the customer has an existing rental portfolio that can service a larger chunk of debt and they intend to use those increased funds to develop, then we're open to talk about that. The key thing for us is we want to make sure the cash flows of the portfolio service the debt, and that's really important to us. We are very happy to talk to people about their needs. Typically, we find that there's an alternative solution that maybe hasn't been thought about. And that's one of the benefits of having that close relationship.
Makes sense. And I guess
the only thing I would probably add to that. So the only thing to add that is if you think about a Handelsbanken customer, our kind of motto is it's all about you. Customers are not just one individual entity. We all have different hats that we wear in our lives. We're parents, we're children, we're employees, we're bosses, we're property companies, we're all these different things. And throughout somebody's life, they're going to have very different needs. And in some cases, very different needs at the exact same moment. So if you think about where you've got your first mortgage, you're having a kid, you're thinking about retirement plans, etc., etc. There's quite a lot that customers need to think about in a relatively short period of time, and that can change quite rapidly depending on how their priorities might change. Let's say they have twins all of a sudden, and all of a sudden they've got to figure out how they're going to finance that. So from our perspective, we don't look at customers as an individual idea. We look at customers in the round. Everybody has lots of different hats they wear in life, and we shape our proposition around those customers depending on what they need throughout the course of their lives.
That's very helpful. That makes a lot of sense. So I guess from a funding perspective as well, which is a question I was going to ask, I guess you're effectively, because you're a deposit taking bank, funds that you lend out are effectively, in a traditional banking model from your own deposits.
Yeah, absolutely. The bank, I don't know the exact funding model of the bank. It's outside my my particular remit, I would say. But what I would say is the bank attracts a lot of customer deposits. We're a fairly traditional lender, basically, conservative lending products. We take in deposits, we lend out money, we move money around, we provide wealth management. That's what a bank's here to do. Great.
Other than not providing development finance, are there any other sort of guidelines around the sort of things that you categorically as a bank don't do that might stop someone going from one branch with a proposition across to another branch with the same proposition, hoping for a different answer?
We try to avoid that, but it's a really good question. That's one of the things that we've had to address as a decentralized bank. You're absolutely right. Different customers may indeed speak to different branches. Our church spire model means that where that customer is registered is where they should bank. We believe we should be closer to our customers. If the customer goes to another branch, we need to communicate as a branch network. There has to be a good reason why that customer doesn't want to bank with, say, here in Jermyn Street. And one valid reason might be that the property portfolio is not on the West End branch patch, if you like. And so they'll say, actually,
Right.
I want to bank in Ealing, for example. We have a conversation about that between the branches, and then there is an agreement that it can be looked at, if that's the customer's wish, in Ealing, and the decision will be made there. What would stop a customer who had a bit of bad news from Ealing coming back to the West End branch? They could certainly try to do that, but we are a bit more joined up around how we do this. In short, credit policies are summed up in 3 words: don't lose money. All bankers should be focusing on that when it comes to looking at any proposition. We are always looking where it's possible to support customers. So if one branch does say no, it's probably for all the right reasons, because they are motivated to lend, because that's the business that we're in. But if they can't do that, typically there's a very good reason for it, and that opinion would also be shared by other branches as well.
And as a broker, passing stuff to Handelsbanken, that is definitely the case. You don't go to one branch and then to another because the answer you get doesn't suit you. You know that there is definitely a joined up approach, and they're all singing off the same hymn sheet. It really is that way. Some lenders, some I've worked at in the past, there's brokers who will go to one relationship manager, and then when they get the wrong answer, they'll go to another one, and then they'll try and get that through credit. And I've actually had it with a challenger bank recently. So I had a customer came to me, first-time developer, refurber, came to me for a loan. I told him, "Oh, this challenger bank won't do that because you're a first-time refurber. That is clearly against their lending criteria." We went with another lender. Base rate changed. Their rate went up slightly. They then went to another broker, spoke to the original challenger bank, asked them for a loan, and they somehow said, "Oh, we're going to forget that bit of credit policy for now," which they shouldn't have. Got all the way through to the last point in the transaction, and now it's been raised by the underwriter as it's in legals that they haven't got the right experience. So these issues can be prevented when communication happens and people talk to each other. And Handelsbanken is a joined up approach, and it's very impressive that they work as a team and doing the right thing for the customer all the way through.
So presumably things like rates and leverage limits, they're sort of standard presets then across the whole of the bank, or is there any element of flexibility with any of those from a sort of branch to branch perspective?
It shouldn't be, is the answer I'll give you that. I don't know if there's specific examples of it, but there shouldn't be. A decision in one branch should be replicated and representative of all the branches. Our motto is the branch is the bank, so your branch is the bank. So if that's the decision taken by that branch, that is the decision taken on behalf of the bank. If we don't do that, it undermines the entire credibility of our operating model, and we'll essentially have a peculiar situation of pawnbroking between one branch to another, which is simply not what we're here to do.
Yeah, makes complete sense. And what is sort of I guess it probably isn't a typical loan level, but what are your kind of maximum? Well, is there a minimum and a maximum when it comes to your loans, or I guess when you've got portfolio borrowers, there might be sort of upper limits on the leverage, but just to give us a bit of a flavour and a guide of what our listeners can expect if they were looking.
Very happy to. Handelsbanken probably fits into the post-development side of the property journey, if you like. So typically we will come in, refinance that development finance at a more affordable rate, because the cash flows of the property portfolio now services that debt, and that releases that cash so they can go off and do other things. If there was a typical amount, and I say every deal is on a case-by-case basis, it would be around about the 50 to 60% LTV on a residential portfolio. It's very rare, very, very rare to see us go beyond that 60%. And the simple reason behind that is that the bank is not here to provide those more leveraged transactions. It's not really what Handelsbanken's about. We see ourselves more on the conservative side of the lending, a long-term relationship where we provide what we believe is a reasonable amount of debt for a portfolio. The only thing to probably add, well, not the only thing, but something to add to that, is where interest rates have had an impact on the overall cash flow of a property transaction. that's no longer where it used to be, we're actually finding loan to value levels are coming down. It's not driven by security, it's entirely driven by cash flow. And that in itself is opening up some challenges for a lot of property investors that had a very good time, relatively speaking, because interest rates were so low. It's been a rapid shift of interest rates. Where interest rates currently at the moment, we may have one more spike to go to 5.5 before things start to settle back. But what it's meant is customers have had to adapt very rapidly to that. Some have been proactive, some haven't. And some have been relatively quiet, and that makes life a little bit difficult when you're trying to support a customer through what we believe might be a difficult time for them. So what we're typically seeing is loan to value is not the challenge at the moment. The biggest limiting factor is cash flow, whereas that wasn't the case prior to interest rates going up.
Very interesting indeed, and it makes complete sense. Would you say that the majority of your sort of loan book then will geared towards portfolio borrowers? I mean, what's the rough split? And it'd be interesting to hear how you think, Marc, this compares to other lenders, the split between sort of single proposition borrowers and portfolios.
So our proposition would be, if I looked at the branch balance sheet here, because I've only got a sight of our balance sheet, I'd say we've got it's a broad mix between personal mortgages or regulated mortgage contracts and portfolio lending, essentially. We do provide single asset finance, but it is deemed to be higher risk, and therefore we need to do more due diligence about that. We typically see that would come into play where you may have a commercial property with a strong tenant, or it might also be that the property is located in a fantastic part of London, prime real estate, and therefore we're comfortable with that. As far as other single assets, it is a case of carefully understanding what sits behind it. But if I looked at our balance sheet, you'd probably say, a good chunk of mortgages on the private side and the property lending side on the corporate.
So yeah, answering your question there, Ro, about how does it compare to other lenders, I would say Handelsbanken are the most relationship driven and least transactional bank out there compared to the others. I think they want to have the relationship with the customer, the overall banking relationship and the understanding of the customer before they enter into transactions. The challenger banks, I suppose, are the opposite with that. They never know who the customer is. It's all about doing one transaction after another, and it doesn't matter who the customer is. It really doesn't matter to them. It's the opposite. So if you get the normal, well, when I say normal relation or normal challenger bank model, imagine the opposite of that, and then you've got Handelsbanken, and not every customer is the same, and there's different ways that they thrive and that they need different services. So Handelsbanken have a big place to play in the market. It really is important that there is a lender like that is concentrating on the relationship and concentrating on the service levels and coming up with the right lending solutions. I'm a big believer of not borrowing too much money, not maximum gearing, not over leveraging, and Handelsbanken try not to let their customers get to that point. They understand risk, and that's the most important thing when banking, understanding risk and understanding the customer. And I think some of the other lenders lose sight of that a little.
Makes sense. Very good. Very good. What's your general things? Just taking a step back, looking at the overall market at the moment. Then, on a recent recording, Marc and I discussed some of the macro events that have been taking place around us. They've obviously been a big driver of the inflation and the environment that we're in with the rates as they are. But what's the Handelsbanken view of the world at the moment in terms of the outlook and where you see the opportunities and threats?
Great. Well, very happy to share my own view because I need to figure out the Handelsbanken view. My view is essentially we're seeing quite a big change in the property market, and it's a story of two halves. On the residential side, it's different to what we're seeing on the commercial side. So I'll quickly deal with the residential market first. We're still waiting to see how inflation and interest rates are feeding through into the residential market. We have seen strong rental growth as a result of interest rates increasing, as those property investors are trying to generate cash out of their businesses. It's providing a few challenges though. Businesses that are more proactive around this, that recognize that they need to address those structural imbalances in their portfolio in order to generate cash for the future, need to do so in a proactive way. And two ways they might look to do that. One of them is to sell some assets so their portfolio becomes smaller for the time being. And the other side might be about looking at how can they use other funds to pay down their debt, so they've got more of a manageable debt level relative to their income. We know that this is a temporary thing and that it will take time to get that balance right. Typically, when we talk to customers about this particular issue, we are looking to support them through that process. And a very simple way to look at that would simply to say, based on this portfolio, what is a sustainable level of debt? If we just wanted the portfolio to break even, so it won't fund your lifestyle, but it will break even. Is that where we start? And if we start there, how much do you need to reduce that facility amount down by? What do you need to do to be able to make that happen? And so we can work with customers to help them to do that. The other side to it is on the commercial element, which is around, particularly here in the West End, we're seeing a lot of work around sustainability at the moment. Everything headed towards 2025 and 2027. And the key thing here is about addressing energy efficiency challenges. There are concerns about stranded assets because these commercial buildings are losing their appeal. And that's because tenants aren't interested in going into a building potentially that's got low sustainability credentials. We're now having lots of stories now where tenants, particularly in certain sectors such as financial markets, will not even take a property if they're not happy with the EPC rating of it. And so there's work to be done there. What does it mean in general across both retail and the residential and into the commercial side? We are most likely going to see a drop in prices. I don't think the drop that we've seen so far is as pronounced as it should be if you look at where rates are going, you look at where the economy is going. So there's potentially a further fall to come through. But I think where the opportunities might be will be to pick up those properties once they start to drop, particularly in the commercial space where we're seeing quite a big drop. Give you an example, one of a business I was looking at recently saw a 40% drop in the value of their commercial property. And that's largely driven by the quality of the property, where it hasn't necessarily been maintained exactly as you'd like it to be, and also the sustainability. EPCs aren't particularly strong, and therefore it's a rush to the floor on pricing. So even from looking at prospective customers' point of view, these are things we will look at. So I would say for businesses, it's about being proactive about these challenges, being realistic about what you can do about them, and working with a bank or with advisors to basically get yourself ready to do that. I'll just quickly, if I may, sustainability is a key part now, and it's going to have a much bigger impact on the property sector, particularly on commercial as we go forward. So it's not just about tenants and the economy and how much floor space we need. It's also about, are those properties sustainable and are they attractive to tenants? Banks are keen to lend for green projects. If you look at a lot of the main high street banks, and Handelsbanken is no different, although we're a private bank, sustainability is key. And we want to support customers through that green transition. If they can do so in a proactive way, working with their tenants, such as introducing green leases, partnering up with them to make sure that they're able to make those changes to their portfolio and improve the quality of that commercial property stock, you'll probably find the values will hold. The Savills quoted very recent, not too long ago, actually last year, that there would be a 40% difference between buildings with a high energy high sustainability credentials and those with low. I actually think it's going to be wider than 40% because we've already seen that happen already. So that's going to be the major opportunity and the major threat. It will mean some players have to leave the market because they're not going to be on that journey. But those that are, I would say, get proactive and get talking to your banks about it, and make sure you've got a good team behind you.
That's very insightful indeed. And actually, that's something that we've not talked about before, but I think the opportunities there are very clear. And I guess if we were to turn that around, how would you, so for me as a property investor, somebody who's looking to buy assets and develop them, that sounds like exactly the sort of assets I would be looking to acquire with a view to actually increasing the value. How might Handelsbanken be able to help me as a borrower? I think I understand that obviously the development finance angle of it I'd need to seek elsewhere, but effectively I would need to create that uplift in value by increasing the energy efficiency, investing that money into it. Is that the point at which I then would be the best time for me to come to you if I was looking to get some term lending on that once we've got a tenant in there?
I think the bank is very interested in exploring how we can support customers making those changes. So if you've got you've got a building and you need to do certain work to it in order to make it more sustainable, the bank would be interested to talk about that. There are talks about a greenium relating to sustainable lending. I think it may even be as much as 30 bips now, and it's increasing, which is where you can see discounts on borrowing because you're using it to improve the sustainability credentials of your properties. So there's a big opportunity there. The bank has just introduced a discount for green lending for our customers because we've got key targets to improve our sustainability and our net zero journey. But more than that, because our branches have full discretion of pricing, we have no pricing committee or matrix when it comes to our corporate debt. If we wanted to discount the facility so that you could make those changes and such that the cash flow worked, then that would be a conversation between you and your banker. So from my perspective, I'm very excited about it because I come from a background where we look at head office to tell us how to do things and what product you're going to launch for us today and how you're going to help us to do it. When it comes to Handelsbanken, we don't need that. We can draft the agreements how we want. We can put the terms in there that we'd like to see, and we can price them exactly how we want to as well. So we don't actually need another team to tell us how to do it. We're already empowered enough to do it. The question is proactivity. Customers really need to come to us to discuss it. And there's a lot of work to be done around that because I feel that some are not on board with it. Some don't have the interest in it or the time, or they just feel it's going to be a bit of a hassle for them. And I do feel to a certain extent, we're going to see some property investors exit the market. We're already seeing some of it in the smaller side of it. But as it relates specifically to sustainability, we're expecting to see more people exit the market, moving property either to family members who are younger, that have a bit more time, have a longer term view. But also the other challenge is where you've got a large portfolio that needs work because it's not particularly sustainable, it's not energy efficient. Dare I say, it is not an empire. It is a portfolio, and it is better to have a better quality, smaller portfolio that's driving cash flow for you with quality tenants than it would be to have a massive portfolio that has headaches all over it and tenants where you keep having to maintain the same rental amount because you can't increase it because they won't pay an income when their energy bills are going up, etc.
Very, very interesting and good to hear your views on that. Certainly, I can see a lot of opportunities there, and I think even with the changes in energy standards or energy efficiency standards that were announced just last week by the Prime Minister, I guess this doesn't really change that, or that doesn't really change any of this because these are still changes that need to be made, and there is obviously a cost for having energy inefficient commercial buildings in the way that you've described. So anyone who's who's looking to offload any of those assets, then I'm always happy to have a conversation. And then obviously perhaps I can have a chat with Marc and Joe about how we can fund such acquisitions. But that's really interesting. Thank you. I don't have any questions on my side. Marc, is there anything you want to sort of quiz a bit further on?
No, I think that's fine. I think we could do a whole new episode on sustainability. I think that's a topic
indeed
we need to address more in depth. So I think that's it from our side. And if you're happy, Ro, we'll call it a day.
Absolutely. Well, thank you very much, Joe. That's been really, really insightful and interesting to hear your views. And of course, we'll put your contact details as well on the show notes so anyone can get in touch with you. But yeah, myself and Marc would just like to say thank you very much for a really, really interesting conversation and sharing a lot of your knowledge with us today.
My pleasure. Thank you both.
Thanks.
Thank you.
That concludes another episode of Show Me the Money podcast, Unlocking Property Finance. Connect with us on social media where we share additional tips, resources, and behind-the-scenes insights. Feel free to reach out to us with any questions or topics you'd like us to cover in future episodes. Until next time, keep exploring, keep learning, and keep making those smart investment moves. This has been Show Me the Money, Unlocking Property Finance. That concludes another episode of Show Me the Money podcast, Unlocking Property Finance. Connect with us on social media where we share additional tips, resources, and behind-the-scenes insights. Feel free to reach out to us with any questions or topics you'd like us to cover in future episodes. Until next time, keep exploring, keep learning, and keep making those smart investment moves. This has been Show Me the Money, Unlocking Property Finance.